Risk management is a fundamental aspect of successful investing, enabling investors to minimize potential losses and maximize returns. One effective approach to risk management is the identification of risks, which can occur at various levels, including industry risk, market risk, and specific asset risk. Investors can utilize tools such as SWOT analysis, which assesses strengths, weaknesses, opportunities, and threats to identify potential risks within their investment portfolio. By knowing what risks exist, investors can formulate strategies to manage them more effectively. Once risks are identified, the next step is risk assessment. This process involves evaluating the likelihood of each risk occurring and its potential impact on the portfolio. One common method to assess risk is through quantitative analysis, where investors can examine historical data and statistical measures like standard deviation and value at risk (VaR). Qualitative analysis also plays a crucial role, as it involves assessing factors that quantitative measures might overlook, such as market trends or investor behavior. By understanding both the probability and effects of various risks, investors can prioritize them and allocate resources effectively to mitigate them. Mitigating risks is where investors can apply several different techniques. Diversification is a key strategy that involves spreading investments across various asset classes, sectors, and geographic locations. By diversifying a portfolio, investors can reduce their exposure to any single asset or market event, decreasing the overall risk. Additionally, using asset allocation strategies allows investors to balance risk and return across the portfolio effectively, tailoring it to their personal risk tolerance and investment goals. Another important risk management technique is the use of derivatives such as options and futures. These financial instruments can serve as hedging tools, allowing investors to protect their portfolios from adverse price movements. For example, a put option can provide insurance against falling stock prices, thereby reducing the downside risk of holding that stock. However, it's essential for investors to fully understand how these instruments work, as they can also introduce additional risks if not managed carefully. Finally, maintaining a continuous monitoring process is crucial in effective risk management. Investors should regularly review their portfolios to assess the current risk landscape and make adjustments as necessary. This can involve rebalancing the portfolio, implementing stop-loss orders, or adjusting asset allocations according to changing market conditions or personal financial situations. By staying engaged and proactive, investors can enhance their ability to manage risks and secure their financial futures. In conclusion, employing a mixture of identification, assessment, mitigation techniques, and continuous monitoring will empower investors to navigate the complexities of investment risk successfully.